What is intermarket analysis? We're going to talk to the expert, John Murphy. Welcome, John.
Thanks, Tom.
You know, many people don't know it, but they talk about intermarket analysis and how all the markets are related now. They don't really call it that. And unfortunately, probably a few of them have not read the book that you wrote, I think in 1990, called Intermarket Analysis. So explain it for our viewers who are uninformed.
Well, when I first wrote that book, you're right, it was 1990. It was kind of heretical. The idea, for example, that all global markets are linked. They move up and down together. People said that's crazy. Anyway, I wrote that, and then I updated it. In 2003. And the main reason I update, well, first let me explain what it is. Intermarket analysis, as the name implies, simply means that all markets are linked. Bonds are linked to stocks. Stocks are linked to the dollar is linked to commodities, and they all impact one another. One of the major changes, for example, that occurred after 2000 was that deflationary tendencies started to appear at the end of 1998 and the early 2000, and that caused a major decoupling of bonds and stocks in a deflationary environment. And you have to go back to the 1930s to find that. Bond prices go up and stock prices go down. That's normally what you have in a depressionary or a deflationary environment. And so that really has been characterized the last 10 years, the fact that in this deflation. So you'll notice even today, whenever stock prices go down, bond prices go up. That wasn't the case 20 years ago. They moved in the same direction. So that was a major change. So even now, so if you're negative on stocks right now, you can buy bonds. Another one is the close linkage between stocks and commodities, for example. Like in a recession, stocks and commodities tend to go down together. And they tend to bottom together, or usually actually stocks bottom a little first. So commodities become an economic indicator, and they're very much influenced by the direction of the dollar. When the dollar goes up, commodity prices tend to go down. So the point of all this is that if you're a stock trader, for example, you have to know what's going on in bonds. You have to know what's going on in commodities, and you sort of have to look at the dollar. And then you have to look at foreign markets, because they're also closely correlated. So you can't just look at any one market in a vacuum. Another whole area is sector rotation. Like, for example, in bear markets, certain sectors of the market tend to do well, like consumer staples and healthcare stocks. Financial stocks and consumer discretionary stocks generally do poorly. So by looking at where the sector strength is and where the weakness is, we can tell where we are in the business cycle. So it sort of borders on economic analysis a little bit. But the point is we're using technical analysis to do all of this. We look at so many things, and we're just looking at charts, and we're saying, well, one thing goes up, one thing goes down. And we're saying if you're going to do a thorough job in any one market, you sort of have to look at what's happening in the other market. And that's the whole basis of intermarket analysis.
Yeah, I remember back in those days, some of the things that you would look at, the copper futures or aluminum futures, then you would look at a stock that was primarily tied to that industry as well, and that gave you some interesting signals. You'd see a major formation that was completed in aluminum. You say, okay, well, here's the best relative strength aluminum stocks that we should be buying.
Or another good example, oil and oil stocks. Like I do a lot of work with exchange traded funds. We have the XLE, which is the energy spider. And then there's an ETF to trade oil, USO, and they tend to trade in the same direction. But sometimes one of them will change direction first. So if you're a commodity trader, for example, and you're trading oil, the oil stocks may turn down first and give you a warning. Sometimes it's the other way around. But all these things are linked. And they sometimes they lead one another, sometimes they don't. But the point is that it's another layer of analysis. If you're trading the commodity, you should always be looking at the related stocks, and the other way around. 20 years ago we weren't looking. We were commodity traders. We didn't look at the stocks.
No, we didn't have the ETFs.
Now you look at everything. And the ETFs are the main vehicle for all this now. I mean, exchange-traded funds, bonds, stocks, commodities, currencies, sectors, foreign funds, long side, short side, whatever you want to do. You can do anything you want with exchange-traded funds. So they have made people like me who trade the markets using intermarket analysis, and we like to trade everything. Exchange traded, you just move in and out with a phone call. Well, not even a phone call, you just a keystroke now. So it's made, so exchange traded fund, intermarket analysis is sort of the theory. Exchange traded funds are the vehicle for implementing that theory. And that's the whole basis of it.
Well said, John. Thank you very much.
Thanks, Tom.
And thank you for watching the MoneyShow.com video network.